Good morning and Happy New Year. It's the first economic briefing of 2023 presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm Rob Knapp, External Affairs Associate at the Institute, and we're glad to have you with us today. Our Chief Economist, Dr. Gerald Cohen, will be with us in a moment to talk about the jobs numbers this morning. He'll also talk about how those might affect the economy and what the Federal Reserve might be thinking as it continues its fight to beat back inflation. For those of you who are with us for the first time, I'll tell you what's going to happen ahead of us. Dr. Cohen will come on, he'll give his remarks for about 15 minutes, and then we turn it over to you. It'll be a question and answer session. You can submit your questions now or anytime during the briefing by using the Q&A function at the bottom of your screen. We do give preference to questions from the press, so if you could please include your name, your title, and your organization with your questions, we would appreciate that. For those of you who are joining us by telephone today, you can participate as well. Email your questions to me at rob_knapp@kenan-flagler.unc.edu. We're going to try to answer all the questions we humanly can in 30 minutes, but we'll get done at 9:30 and get you on your way after that. So without further ado, it's time to bring on Dr. Gerald Cohen, our Chief Economist. Gerald, good morning. I hope the jobs numbers are looking good and you have some interesting things to say about them today.
Good morning, Rob. Yes, it's been an interesting and busy morning. So look forward to discussing the data and the implications. Let me start by sharing my screen so we can start to look at the data. Hold on, I just need to let me turn this on or put myself into slide mode. So it's interesting. We had continued to have strong and actually greater than expected employment and generally healthy underlying data. So 223,000 jobs were created. Gains in manufacturing, gains in construction, which might be actually quite strong gains, 28,000 gains in construction, which might be surprising. Hourly earnings up, a little bit decline in hours. The unemployment rate back down to a 50-year low of 3.5%, and a little bit of an increase in the labor force participation rate. So all of those are good news. I do want to start, though. I'm sorry to kind of push on a negative note, but last month I discussed how my favorite economic indicator, the spread between 10-year treasuries and 3-month treasuries, which I think has been in the news a lot, has turned negative. And that to me is an indicator that a recession is on the horizon. And so I want to discuss a little bit about why I think what we are going to have a recession, but why the recession, I believe, will be mild. I mean, the reason we're going to have a recession is the Fed has raised interest rates substantially. You're seeing, given the long and variable lags, you're going to see the impact on employment. You're seeing a little bit of an impact of that and inflation on spending. But I ultimately believe that we will end up in a recession, but I think it's going to be mild. And the reason why I think it's going to be mild is because balance sheets are healthy. So this first chart illustrates that households have over $2 trillion in excess savings, which should cushion the downturn. There's data that separates the household wealth into, and this 2 trillion is sitting in bank accounts. It's not stock market, gains or losses. It's money that's like sitting in bank accounts that's kind of meant to be spent or ready to be spent if necessary. It's not like that people have to sell stocks or bonds to do this. And as you can see, it is concentrated in the top 50% of households. although there was a little bit of an increase in the bottom 50% of households. But this generally should cushion the downturn and keep households, especially the upper 50% of wealth, spending. Unfortunately, it's generally the lower 50% that gets hurt most by recessions, and that's where you need government support and in the form of unemployment insurance. But I think this suggests that that spending will not decline as much as in previous recessions because of this increase in income. The other aspect is that we're seeing fairly healthy debt levels. This is the debt to income ratio. You can see it really accelerated in the run-up to the global financial crisis, when households took on a lot of housing debt. This tends to be an accelerant to recession. So what happens is household debt if you have high levels of household debt and income turns down, what will happen is people will default. That will cause banks to pull in their horns and stop lending, or banks to stop lending, and that has kind of a multiplier effect. You're not seeing these very high levels of debt, and so relative to incomes, and so we think I believe that's one of the reasons why you will have a mild downturn. The same is true in the business sector. And then lastly, job openings remain high, which is one of the reasons why we continue to have above expected employment numbers. And one thing to note is that if we had a recessionary drop, so if you saw a decline in openings on par with what you saw during the global financial crisis in 2008, that would put us back to pre-COVID levels. So this suggests that there's still strong demand for employment, and even in a slowing economy, there's just all these openings that could be filled. So let me now start. So that's kind of the backdrop, and then let me start with the kind of. So this is what we've known before today, and then let's. And I don't think anything really has changed with today's employment, with the one exception, with one or two exceptions, which I will discuss momentarily. So as I said, employment was up 223,000. It was greater than the 200,000 that was expected. Previous months were revised previous month were revised down a net 28,000. Sorry, that was a tongue twister. I do look at these revisions as a negative sign. It's not that much. I mean, and in particular, given the positive 223,000, the kind of net employment number is only -5, because we have greater than expected in this month, but downward revisions in the previous. So I think that's kind of a wash. The thing that worries me the most is this downturn in temporary help jobs. I talked about this last month, and this accelerated. In this month, we saw a 35,000 drop in temporary help jobs. It's the 5th consecutive monthly decline. As you can see, this tends to be a contemporaneous or a leading indicator. And so it's consistent with my view that we're headed towards a recession. It seems a little early, given that I believe the recession is going to occur in the latter half of this year. But it is kind of I'd say one of the few signs that we saw in this report of a kind of recessionary that we're headed towards recessionary conditions. The other area that is just all over the news is tech. Salesforce laying off 10% of its workforce. All these announcements, and interestingly, despite the news of all of this, tech employment continues to grow. I apologize, we had some data issues, so this graph is very ugly at the moment, and the bottom scale is 6,000 plus jobs. It should have been 0. We had some issues. Although I must have to give great compliments to my colleague Wan Lian, who's doing this behind the scenes very, very quickly. So she deserves a lot of credit what all of these great graphs. But we did had some issues getting the data in. What this graph is showing is that tech employment actually increased in the month, or the gain accelerated in December, despite all this bad news. And what we're seeing in this data, and what we're hearing from from businesses that we're talking to, is that these tech jobs are still in demand. They may not be in demand in the tech industry, but for example, the Salesforce tech jobs may be, those folks are in demand. Maybe Salesforce are laying people off, but GM is hiring them because they need people to develop software for their self-driving cars, for their electric vehicles. So what we're hearing is and we're going to follow this closely, but it's interesting to note that tech employment continues to grow despite all the bad news. And this is kind of consistent with all those job openings that I discussed. The unemployment rate, as I mentioned, declined to a 50-year low or edged down to a 50-year low of 3.5%. And the labor force participation rate edged up, and both in prime age, which are kind of your key workers, 25 to 54-year-olds. These are that's the age group that is most likely to be working, but also slightly in the 55 and older, which has really took a hit. And we wonder whether risks of a recession or an outright recession will cause people to actually come back into the labor force. Because they'll say, look, I thought I could manage, without a job, but, declines in my stock portfolio, it doesn't look great out there. Maybe I should actually start looking for a job again. So something be interesting to watch. Wage gain, there were wage gains, but you're starting to see some deceleration in that. And again, their inflation is eroding that purchasing power, which is one of the reasons why we're expect to see continued slowing and potentially declines in consumption. Although, as I said, mitigated by the high levels of savings. Interestingly, we've been worried about a wage price spiral, but despite the fact that inflation is well above wage gains, it hasn't materialized, and we think because expectations remain well contained. Sorry, I just want to be conscious of the time. The gap between strong hiring and GDP growth is narrowed, with Q4 hours suggesting positive 1.1% GDP growth. That assumes no productivity gains. Productivity has been all over the map. You should look at our report on 2022 large city extended metro area productivity. We released that about a month ago. But if you assume some productivity gains of roughly 2%, which is the historical average, that suggests 3% GDP growth. And that's about where the Atlanta Fed's GDP Now forecast is putting us. Meanwhile, the Fed continues to be hampered by high inflation. Yes, you're starting to see, you saw some slowdown in headline numbers. You're starting to see some slowdown in the core inflation numbers. The blue line is the kind of 3-month annualized. I know it's messy, but it's illustrating that there's some slowing, but it's still well above 2%, which is why the Fed continues to say they're going to raise rates. Why in their minutes that were released this month, they're saying, look, yes, we're seeing some positive signs, but it's not enough for them. And one of the reasons is because you're seeing this shift in the dynamics. Service inflation is accelerating, while goods inflation, or has accelerated and is now quite high relative to history, while goods inflation is coming down. And as I mentioned last month, that service inflation it's a little harder to slow that down because it's in places like housing. And the dynamics just take a lot longer. With goods, if you can ramp up production, which we're finally done in the chip sector, the auto sector, you can see that supply increase increase and push demand down. It's just harder to build houses. And we're actually seeing now a slowdown in the housing market, which ultimately should lead to declining rents and declining service inflation, but the dynamics take more time. And this is the reason why the Fed is going to continue to raise rates. But interestingly, the markets are now saying, I'm saying there's going to be a recession. The markets are saying, look, they're going to raise rates. And then by the end of the year or by mid-year, they're going to start to cut rates, which is a really interesting dynamic. You could say, why is the Fed raising rates if everybody is telling them they're going to have to cut it sooner? And that's because of a credibility issue. They let inflation rise too much, and so they're going to have to suffer the consequences. So let me stop there. Open it up to questions. Look forward to your questions.
All right, thank you very much. That was a lot in in a short amount of time. So appreciate all your analysis. Appreciate all of Juan's hard work, as you mentioned as well. That's a lot to cover in 30 minutes. Just to go back to one thing, there are a lot of unusual things going on. It seems like maybe we should just change the name of the economic briefing to Stranger Things. But is it this continued need to fill jobs that's sort of the driving strange thing in a lot of this?
Yeah, that's it. That is it, Rob. I appreciate that question. And by the way, I forgot to mention two things, so I'm going to take this as a reminder. And this relates to your question. I just put out my kind of 2023 year ahead piece. It's not really, predictions. It's more a set of questions. And one of the questions that we're grappling with, and we've taken on as a kind of a grand challenge, is this issue of labor market dynamics. And so we're going to be spending a lot of time thinking about this issue regarding the supply of labor and the demand of labor. And what we're just hearing from businesses, and we just had a meeting 2 days ago. We had a meeting last month and then 2 days ago with businesses, and they're saying, look, there is just continued demand for skilled labor. And that's irrespective of where we think the business, and this is businesses from healthcare to finance to manufacturing, we just need skilled people, and those people are in demand, and that's irrespective of what happens to the economy, because we feel that, we need that skilled labor to make our businesses more efficient, to make produce the goods and services that we need. And so that's why these job openings are high, and that's why in some respects the tech employment remains so strong. So that is exactly, I don't think we've ever had a dynamic where just the demand for labor is so strong, despite the fact that everybody is talking about a recession and companies are talking about a recession. So it's, and unfortunately, some of it is we may have talked ourselves into this recession because of that, but we're saying, look, we think there's a recession, we think demand's going to go down, but we still need these people, which is really, isn't really consistent, because if you're saying you're going to hire people, that means demand should remain strong.
Yeah, strange days indeed. So thanks for answering that. And you make a good point. You bring up the piece you've written on 5 trends. There's another piece that is about the growth projections for the top 50 microeconomies in the U.S., which tags on after the same thing that we did back in October for 2022 for those same microeconomies. Both of these things everyone can find at www.americangrowthproject.com. Good reads, both of them, and a lot of hard work by Gerald and the crew to make those things happen.
Thanks. Yes, thanks, Rob. I meant to mention that as well, to say that, we've dug into our forecast of recession in 2023, yet we actually have over 30 of the largest microeconomies or large metro areas in the country are actually expecting positive growth or slightly positive growth. And one of the things that we're really trying to illustrate is how how different cities, different areas of the countries there's very large differences or variance in economic conditions or throughout the country. And so how we can be in a recession, but still have over half of our largest cities having positive growth. So look out for that report as well.
Yes, it's a great example of how that one big national number does not tell the whole story.
Yes, exactly.
All right. We have some questions to answer. So we'll get right to them. First one is from Eric Spanberg at Charlotte Business Journal. He says, how do you see North Carolina's economy faring in 2023, particularly in the larger metro areas of the Triad, Triangle, and Charlotte? Do you see any notable strengths or weaknesses?
So thanks for that question. Interesting, it dovetails very well with the issues that we discussed or what we just mentioned around these large microeconomies or large extended metro areas. And it's a bit of a mixed picture. So we continue to expect that the Triangle area will grow quite strongly. It is I think number 4 or number 3 of our fastest growers in 2023. However, it also is one of the biggest slowers of 2023 between 2022 and 23. And that's because of the things like the expected tech slowdown. We're still saying that employment is going to grow, but it's slowing meaningfully. And that is going to have an impact. And I think in particular for the Triangle, one of our worries, I mean, my biggest concern in the Triangle area is that all the companies that have said that they're going to move to the region will not happen. But if it pans out, I don't want to make any forecasts about that, but I would say that these projects generally have a very long life cycle. So, once a company decides that it's moving and it's putting together the infrastructure, generally they will move unless something major happens. So as long as that doesn't happen, that means that you'll continue to get healthy employment growth, generally healthy demand for housing. And that's why we think the Triangle is going to be one of our fastest growth. And these jobs are highly paid, highly productive. And that's why we think the Triangle is going to be growing faster. Charlotte will get hit a bit by the impact of the finance sector, but again, will continue to grow, albeit slower. And in between, the Triad region, I think just has challenge. On the one hand, is seeing some shift in its employment in the what's happening in the employment dynamics, but it also still is heavily dependent on the manufacturing, and that tends to be much more cyclical. Although again, it's harder to know in this cycle. So overall, we think that the state will do well because of its underlying dynamics, because of the strong migration into the state, but it's definitely slowing. It's definitely slowing.
Okay, thanks very much. You covered a lot of ground there, and
yes.
It's Eric's job to figure out which companies are still coming and which ones aren't. So we'll leave him to that. This is sort of a twist on the question from Lauren Onesorge at the Triangle Business Journal, and she asked, what should the takeaway from all of this be for Triangle business leaders? So what should they be thinking and doing, knowing all of this?
I think it is a little bit of the kind of tale of two worlds, where you're seeing strong demand for the types of skills that the Triangle is noted for, tech, biotech. We're fortunate with our universities and kind of the skills levels that we're creating, and so I think that's the positive. The flip side is that higher rates have an impact on ability for businesses to expand and so that's a challenge. And so, I think there's definitely this push and pull. and so that's the kind of, I think overall the triangle, as I said, will still grow quite strongly, although definitely slower than it has been for the last several years.
Okay.
And you should look out for the report where we actually illustrate all 50 of these extended metro areas, and you can see the exact numbers. I'm sorry, I don't have them. I don't have the exact numbers off the top of my head.
Yes, but we have them on the website. So excellent plug. And we'll remind folks of that when we send the email out after the briefing. This from Dan Barkin at Business NC. How high do you think the Fed funds rate will go and when?
Dan, I wish I had a crystal ball. So I'm going to lean a bit on the markets and say, I think that the expectations of around a 5% funds rate seems a reasonable number. So, I'm not sure that they're going to do it in one fell swoop. I would anticipate that they will, I think they've, slowing their rate hikes. And I think, I'm going to say closer to in the first half of the year, I think the markets are anticipating something around, the April or May. And so I would say that's where I'm actually maybe going to disagree a little bit with the markets. I think probably sooner that they're going to get to the peak sooner. And then the question is when they start to cut rates. But I'll say I'm going to go with the markets in terms of the level 5%. I'm going to say that they're going to get there a bit sooner, but still, and maybe another 50 and then 25. Not in one fell swoop.
Okay, we have that on video, so we'll check back on that in a little bit.
And let me note that they have said that it's data dependent. And I really want to stress that, but the key, as I mentioned in my 2023 report, is that inflation, and this was before the minutes, inflation, I wrote this before the minutes, inflation has to come down more for them to stop, to pause.
Okay. Quick one from Arthur McGimsey, forward looking. What's the Fed's first response when they deem inflation has been stamped out? Lower interest rates?
It's a very good question. What I would say is it's dependent on the other factors of the economy. So if employment continues to grow at 200,000 or 200,000 plus, which really is above the kind of sustainable number, they'll stop, but they will not ease, because really they need to get things to slow more than that, or else inflation will not come down to 2%, or inflation would pop back up. So I think it's a combination of, it's not just the inflation numbers, although that's like a key driver because they've kind of got them, they have this credibility issue, but it's inflation and the employment numbers. If inflation is slowing and we have negative employment growth, then they could cut pretty quickly. If inflation is slowing and we're still having strong employment numbers, then they're not going to cut. And then there's that middle ground, which we could discuss offline.
Okay. A couple of quick ones. We're getting toward 9:30, so we'll do lightning round on these. From Peter Pignataro, what impact will the housing slowdown mean to the economy?
It definitely is important. And, in two aspects. One, as I mentioned, I think not particularly clearly, the impact on inflation, although that's more lag. The other one is just the impact on economic activity, which is clearly a drag. But there's this just push and pull that I'm sorry that I keep talking about, but, strong employment means healthy consumption, despite the housing slowdown. You also have this dynamic of, whether we're still undersupplied in housing, which I believe to be the case. And so, that housing slowdown could be relatively short-lived. And then there's this dynamic with debt numbers. So, if we really see a big decline in housing activity and in housing prices, and people are trying to sell, then that could have this impact on the health of balance sheets, the health of banks. And finally, and I haven't mentioned this before, but there's the dynamics of people moving. And so, if people are locked into their homes because they don't want to move out of a house where they have a 2% mortgage into a house that they have a 6% mortgage, they may be less apt to move to where the jobs are. So that could actually negatively affect places like North Carolina, where we're having a lot of people moving because they may not be willing to do so because they don't want to leave. They're kind of locked into their homes. So again, more to discuss on that. And I realize we're short on time, and I've not been great in the lightning round.
No, you've done great as always. I think we'll close it down there. For those of you who have a 9:30 and need to jump, don't worry about missing my closing. I won't take it personally. But Gerald, thanks again as always for your insight and your answers to all the questions. Also, a big thanks to everybody who attends and asks these great questions. They really make the briefing what it is, and we do appreciate it. For all of our media members out there, if you'd like to continue the conversation with us, we'd love that. If you'd like to talk to Dr. Cohen or any of our other experts about the economy or hiring or anything else, please reach out to me at rob_knapp@Kenan-Flagler.unc.edu. For everyone out there, we hope that you will check out our website so you can see the full breadth of the research and the things that we're doing. We are at Kenan-Institute.unc.edu. And in addition to that, we spoke about our American Growth Project, a couple of new things up there. You can find that through our website, but there's also a direct URL, www.americangrowthproject.com. I think that is it for this week. Thanks again. We will be back here on February 3rd. The new jobs report will be out, and we will be here to talk about it. So until then, thank you very much and have a great Friday. Bye-bye.